What if I told you that the difference between the rich and the poor isn't luck, talent, or even hard work, but simply how they see money? Welcome back to MoneyLens, where we sharpen your view on finance. I'm Ben Carter, and today we're diving into a sobering reality: why 90% of investors lose money and the specific habits, mindsets, and strategies that separate the successful 10% from everyone else.
You know, I was talking to a friend last week who just started investing. He was so excited about this hot stock tip he got from Reddit. He put in $5,000, almost his entire savings, into a single biotech company because it's going to the moon next week. Sound familiar? That's exactly how most people approach investing, and precisely why most people lose money in the markets. According to data from Dalbar's quantitative analysis of investor behavior, over a 30-year period ending in 2020, the average equity fund investor earned an annualized return of just 5.04%, while the S&P 500 returned 9.06% annually. That's a gap of over 4% per year, which might not sound like much until you realize that means the average investor is leaving about 44% of their potential wealth on the table over a decade. Today, I'm going to break down exactly why this happens, the psychological traps, the strategic errors, and the systemic challenges that cause 90% of investors to underperform or lose money outright. More importantly, I'll share the research-backed methods that the top 10% use to consistently build wealth through investing. Let's sharpen that financial lens and see what most people are missing.
Part 1. The reality of investor performance. Before we dive into why investors lose money, let's establish some facts about investor performance based on reliable data. According to a comprehensive study by J.P. Morgan, looking at the 20-year period from 2000 to 2019, the S&P 500 delivered an average annual return of about 6.06%. During that same period, the average individual investor earned only 2.5% annually. That's less than half the market return and barely keeps up with inflation. Another study from the Massachusetts Institute of Technology found that only about 10% of day traders are profitable in any given year, and just 1.1% earn returns that significantly outperform the broad market indices consistently. The facts are clear. The vast majority of investors are not making money at the rate they could be, and many are actually losing their capital altogether. So, what's going on here?
Part 2. The psychology behind investment failure. Let's start with what I believe is the #1 reason investors lose money: our own brains. Emotional decision-making. Humans evolved to survive on the savannah, not to make rational decisions in financial markets. Our brains are wired with cognitive biases that served us well as hunter-gatherers but sabotage us as investors. The amygdala, our brain's fear center, is constantly scanning for threats, which is why we tend to panic when markets drop. This leads to one of the most common and destructive patterns in investing: buying high and selling low. According to data from Morningstar, fund flows consistently show that investors pour money into funds after they've performed well and withdraw money after they've performed poorly. This reactive behavior is practically a formula for underperformance. Loss aversion. Research from behavioral economists like Daniel Kahneman and Amos Tversky shows that the pain of losing money is psychologically about twice as powerful as the pleasure of gaining the same amount. This loss aversion explains why many investors hold on to losing positions far too long, hoping to break even, while they rush to sell winners too early. A study in the Journal of Finance found that individual investors were 1.5 times more likely to sell a winning stock than a losing stock, effectively cutting their flowers and watering their weeds. Overconfidence. Here's a sobering statistic. In a survey of professional fund managers, 74% believe they were above average at their job. Mathematically, that's impossible. This overconfidence leads to excessive trading, concentration in sure-thing investments, and ignoring contradictory information. Research from the University of California found that investors who traded the most earned annual returns 6.5 percentage points lower than investors who traded the least. Recency bias. Our brains are wired to overweight recent experiences. If tech stocks have been booming, we assume they'll continue booming. If the market has been in a downturn, we assume it will keep falling. This recency bias leads to performance chasing, buying whatever has been hot recently. According to Morningstar data, funds that received the most inflows based on recent performance subsequently underperformed their peers over the next 3 to 5 years.
Part 3. Strategic errors that doom investors. Beyond psychology, there are specific strategic errors that separate the unsuccessful 90% from the successful 10%. Lack of a clear investment plan. According to a survey by Charles Schwab, only 33% of Americans have a written financial plan. Without a roadmap, investors are essentially driving blindfolded. They have no clear asset allocation, no defined risk parameters, and no concrete goals beyond make money. The top 10% of investors, in contrast, have detailed investment plans that specify their time horizon, their risk tolerance, their asset allocation targets, their entry and exit criteria, their rebalancing schedule. When markets get volatile, these plans serve as an anchor that prevents emotional decision-making. Poor diversification. According to data from OpenFolio, the average retail investor holds just 4 stocks. That's dangerously concentrated. Even professional portfolio managers typically hold 20 to 30 stocks at minimum. A study in the Journal of Financial Economics found that about 58% of individual investors have more than half of their portfolio in a single stock, often their employer. This concentration dramatically increases risk without a corresponding increase in expected returns. Proper diversification isn't just about holding more stocks, it's about holding assets that respond differently to economic conditions. The top 10% of investors understand that diversification across asset classes, stocks, bonds, real estate, etc., is even more important than diversification within asset classes. Trying to time the market. Here's a staggering statistic from a JP Morgan study. If you had invested in the S&P 500 for the 20-year period from 2000 to 2019, but missed just the 10 best trading days, your annualized return would drop from 6.06% to 2.44%. Miss the 20 best days and your return goes negative. The problem is that the best days often follow the worst days closely. Investors who try to time the market by jumping in and out based on predictions about market movements almost invariably miss these crucial recovery days. According to Dalbar, market timing is one of the biggest contributors to the gap between market returns and investor returns. Fee blindness. Many investors focus exclusively on returns while ignoring the drag of fees. A seemingly small expense ratio of 1% on a mutual fund reduces a 7% annual return to 6%. Over 30 years on a $100,000 investment, that 1% difference compounds to nearly $340,000 in lost wealth. According to Morningstar research, fee levels are actually a better predictor of future fund performance than star ratings or past returns. The lower the fee, the better the odds of outperformance. The top 10% of investors are ruthless about minimizing fees, favoring low-cost index funds and ETFs for core portfolio positions.
Part 4. Systemic Challenges and Information Asymmetry. Beyond psychology and strategy, there are structural reasons why retail investors face an uphill battle. Information asymmetry. Wall Street professionals have access to Bloomberg terminals, $24,000 per year, high-frequency trading algorithms, satellite imagery of retail parking lots, and alternative data sources that cost tens of thousands of dollars. According to a study in the Journal of Finance, institutional investors consistently earn higher returns on their trades than individual investors, suggesting they have an information advantage. The top 10% of individual investors recognize this disadvantage and avoid trying to compete with Wall Street on short-term trading. Instead, they focus on areas where they might have an information edge, such as local real estate markets or industries related to their professional expertise. The financial media problem. CNBC, Fox Business, and financial news websites generate revenue through advertising, which requires viewer engagement. This creates an incentive to promote sensationalism, fear, and greed, exactly the emotions that lead to poor investment decisions. A study from the National Bureau of Economic Research found that investors who consumed financial media regularly traded more frequently and earned lower returns than those who tuned it out. The successful 10% consume financial information selectively, focusing on long-term fundamentals rather than day-to-day market noise. The product-pushing financial industry. Most financial products exist to generate fees, not investor returns. The financial services industry employs sophisticated marketing to sell complex products that often underperform simpler, lower-cost alternatives. According to S&P's SPIVA scorecard, over 80% of actively managed funds underperform their benchmarks over a 15-year period. Yet these funds continue to gather assets because they're actively marketed, while index funds generally are not. The top 10% maintain a healthy skepticism towards innovative financial products and focus on tried and true investment vehicles with transparent fee structures.
Part 5. How to join the successful 10%. Now let's talk about what sets the successful 10% apart. These aren't just theoretical ideas, these are evidence-based principles practiced by consistently successful investors. First, develop an evidence-based investment philosophy. The successful 10% have clear investment principles grounded in academic research rather than hunches or hot tips. According to a study in the Financial Analyst Journal, investors who adopted evidence-based principles like those promoted by Vanguard founder Jack Bogle or academic researchers like Eugene Fama and Kenneth French achieved returns that were substantially higher than the average investor. Key elements of an evidence-based approach include understanding that markets are largely efficient but not perfectly so, recognizing that asset allocation explains about 90% of a portfolio's volatility over time, accepting that risk and return are related, and acknowledging the power of compounding and the destructive impact of fees. The second thing to do is create a written investment plan and stick to it. According to Charles Schwab, investors with written plans are more than twice as likely to stay the course during market downturns. Your investment plan should include clear financial goals with specific time horizons, a target asset allocation based on those goals and your risk tolerance, guidelines for when and how to rebalance, criteria for selecting specific investments, and a process for reviewing and updating the plan. The key is not just having a plan, but sticking to it, especially when emotions run high during market extremes. The third thing to do is embrace rational diversification. The top 10% understand that diversification is about more than just holding different stocks. It's about holding assets that respond differently to economic conditions. A landmark study by Brinson, Hood, and Biebauer found that asset allocation explains about 90% of a portfolio's return variability over time. In other words, your mix of stocks, bonds, real estate, and other asset classes matters far more than which specific stocks or bonds you choose. Modern portfolio theory suggests that combining assets with different correlations can increase returns while reducing risk. The successful 10% create portfolios that balance
domestic and international stocks, growth and value styles, large and small companies, stocks and bonds, and traditional and alternative assets like real estate or commodities. The fourth thing to do is harness the power of automated investing. According to a study by investment firm Vanguard, automated investment plans lead to significantly higher account balances over time compared to self-directed accounts, primarily because they remove emotion from the equation. The top 10% set up automatic contributions to their investment accounts, ideally timed to their paychecks, ensuring they consistently invest regardless of market conditions. This approach naturally implements dollar-cost averaging, which helps avoid the timing pitfalls that plague most investors. The fifth thing to do is focus on what you can control. The top 10% concentrate their energy on the few factors they can actually control: how much they save and invest, the fees they pay, their asset allocation, their behavior during market extremes, and the tax efficiency of their investment strategy. According to Vanguard research, these controllable factors can add up to 3% in additional returns annually compared to the average investor. The top 10% ignore factors they can't control, such as short-term market movements, Federal Reserve decisions, election outcomes, or economic data releases. The sixth thing to do is practice emotional discipline. According to neuroscientist Antonio Damasio, emotions play a crucial role in decision-making. The top 10% don't try to eliminate emotions, they manage them. Successful investors create systems that help them maintain discipline. They avoid checking their portfolios daily, they write down their investment thesis before buying, they keep investment journals that document their decisions and rationales. They sometimes work with advisors who serve as behavioral coaches. Research from Vanguard suggests that behavioral coaching, helping investors stick to their plans during market turbulence, is the single most valuable service a good financial advisor provides. And lastly, continuously educate yourself. The top 10% are lifelong learners. According to a study by Spectrum Group, affluent investors read an average of 7.5 hours per week. But here's the key: they focus on timeless investment principles rather than hot tips or market predictions. They read books like A Random Walk Down Wall Street by Burton Malkiel, The Intelligent Investor by Benjamin Graham, and Common Sense on Mutual Funds by John Bogle. They also learn from their own mistakes, reviewing and analyzing their investment decisions to identify patterns and improve over time.
Part 6. Case studies of the successful 10%. Let's look at some real-world examples of how the principles we've discussed translate into actual investment approaches. The index investor. Consider Sarah, a 35-year-old software engineer who follows the indexing approach championed by Jack Bogle and Warren Buffett. Sarah invests 20% of her income automatically each month into a simple portfolio: 70% in a total world stock market index fund, 20% in a total U.S. bond market index fund, 10% in a REIT index fund. She rebalances once a year and increases her contribution percentage with each raise. Her total expense ratio is under 0.1%. During the 2020 market crash, while many investors panic sold, Sarah actually increased her contributions, recognizing the market decline as a buying opportunity. As a result, her portfolio has outperformed 85% of professionally managed funds over the past decade, according to data that tracks such comparisons. The value investor. Michael, a 42-year-old accountant, follows a value investing approach similar to that of Warren Buffett. Michael invests in companies with strong balance sheets, low debt-to-equity ratios, consistent free cash flow, durable competitive advantages, and prices below his calculated intrinsic value. He holds between 20 and 25 stocks across different sectors and maintains a cash reserve of about 15% to deploy during market downturns. While his portfolio is more volatile than Sarah's index approach, Michael has generated annualized returns about 2% above the S&P 500 over the past 15 years. More importantly, he sleeps well at night because he understands what he owns and why he owns it.
The goal-based investor. Jennifer, a 38-year-old physician, takes a goals-based approach to investing. She has 3 separate portfolios aligned with different life goals. A conservative portfolio for her home down payment fund, 2-year horizon. A moderate risk portfolio for her children's education, 12-year horizon. An aggressive growth portfolio for retirement, 25+ year horizon. Each portfolio has its own asset allocation appropriate to its time horizon and purpose. Jennifer never makes withdrawals from one goal to fund another, maintaining the integrity of each strategy. By connecting her investments directly to her life goals, Jennifer finds it easier to maintain discipline during market volatility because she can focus on the appropriate time horizon for each goal.
Part 7. Common pitfalls even among the 10%. Even successful investors make mistakes. Here are some pitfalls that can trip up members of the top 10% and how to avoid them. Portfolio creep. Over time, even disciplined investors can end up with a collection of accounts and investments that lack cohesion. According to research from Morningstar, investors who consolidate their accounts and simplify their holdings generally achieve better returns with less stress. The solution is to conduct an annual portfolio review where you look at all your investments together, checking for overlap between funds, drift from your target asset allocation, and opportunities to consolidate accounts, and tax loss harvesting possibilities. Success-induced overconfidence. When investments perform well, it's easy to attribute success to skill rather than favorable market conditions. This can lead to increased risk-taking and concentration. According to a study in the Journal of Finance, investors who experienced above-average returns were more likely to subsequently concentrate their portfolios and increase their trading activity, both of which led to deteriorating performance. The antidote is to regularly remind yourself of the role of randomness in short-term outcomes and to maintain your disciplined approach regardless of recent results. Lifestyle inflation. As wealth grows, spending often follows. According to research from Sarah Stanley Fallow, co-author of The Next Millionaire, Next Door, maintaining a high savings rate is more important for building wealth than achieving above-average investment returns. The top 10% of wealth builders maintain their savings rate even as their income increases, allowing them to accelerate their wealth accumulation rather than their consumption.
So there you have it. The psychological traps, strategic errors, and systemic challenges that cause 90% of investors to underperform, along with the evidence-based principles and practices that define the successful 10%. The good news is that joining the top 10% doesn't require a genius IQ or insider connections. It requires understanding the research, creating a sound plan, and most importantly, developing the emotional discipline to stick with that plan through market cycles. Remember these key takeaways. Develop an evidence-based investment philosophy. Create and follow a written investment plan. Embrace rational diversification. Harness the power of automated investing. Focus on what you can control. Practice emotional discipline. Continuously educate yourself. And that's how you sharpen your financial lens. If this episode opened your eyes to something new, hit that like button and subscribe for more weekly insights that could change your financial future. Drop a comment below. What's your biggest financial challenge right now? I read every single one. Until next time, keep your lens focused on what matters. This has been Carter, and you've been watching MoneyLens.